Netflix just crushed earnings. Revenue beat, EPS beat by 62%, and the stock dropped 9% after the bell. Let me explain why Wall Street just punished a beat. Welcome to the Money Mind. Netflix reported Q1 2026 earnings right after the bell today, April 16th. We are going to walk through the quarterly numbers, the next quarter guide, the full-year outlook, and then the most important moments from the earnings call, including the analyst questions that actually mattered. Start with the headline. Revenue came in at $12.25 billion, up 16% year over year and 14% on a foreign exchange neutral basis. That beat the $12.18 billion consensus. Operating income rose 18% to $3.96 billion. Operating margin hit 32.3%, which was above what the company guided. And earnings per share came in at $1.23, blowing away the 76-cent consensus. Now here's the asterisk. That massive EPS beat is not purely operational. Remember, Netflix walked away from the Warner Bros. Discovery deal and collected a $2.8 billion termination fee. That cash hit the income statement this quarter in the line called interest and other income. So if you back out the one-time windfall, the beat is much smaller. Still a beat, but not a 62% beat. Wall Street knows this, which is part of why the stock reaction was muted even before the guide. Management called out three drivers. First, membership growth. Second, pricing. Netflix raised prices on both the standard plan and the ad-supported plan in late March. Third, advertising revenue is scaling. And here's the stat that matters. In the ad-supported countries, the ads plan accounted for more than 60% of new signups in the quarter. That tells you the ad tier is officially the front door for new customers, not a side offering. Now the bad news. The Q2 guide is where the stock broke. Netflix guided Q2 earnings per share to about 78 cents. Consensus was 84 cents. That is a clean miss. Operating margin is expected to dip about 1.5 percentage points in the quarter. Why? Higher content spend and marketing tied to a heavier second quarter release slate. For a stock priced for smooth execution, even a small margin dip scares fast money. On the full year, the picture is a mixed bag. Management reaffirmed 2026 revenue guidance of $50.7 to $51.7 billion, midpoint $51.2 billion. That is right in line with consensus at $51.38 billion. Operating margin guidance stayed at 31.5%, which is slightly below the 32% consensus. Free cash flow got a real upgrade, now projected at about $12.5 billion, up from the prior $11 billion and above the $12.05 billion estimate. And ad revenue is still guided to $3 billion for the year, doubling from $1.5 billion in 2025. So the cash is fine. The margin is just a little softer than Wall Street wanted. Moving to the earnings call, co-CEO Ted Sarandos and co-CEO Greg Peters led the session alongside CFO Spence Newman. The opening message was consistent. Netflix is not acquiring Warner Bros. The $2.8 billion termination fee is essentially a free war chest, and management wants shareholders to know they will deploy it into content, not a dividend or buyback bonanza. That framing was deliberate. They are signaling discipline after a messy M&A saga. The single most discussed topic on the call was advertising. Greg Peters reiterated the path to $3 billion in 2026 ad revenue. He noted that the in-house ad tech stack built over the past 18 months is now fully operational, and programmatic ad buying is scaling. When an analyst asked about the mix of direct versus programmatic, Peters said both channels are growing, but programmatic is the bigger volume lever going forward. He also confirmed that the cost per thousand impressions, or CPM, in live event slots is significantly higher than on demand. That is the hook for why live matters. Ted Sarandos spent real time on live. The context is simple. Netflix has the 10-year, $5 billion WWE Raw deal, Christmas Day NFL games, and exclusive United States rights for the 2027 and 2031 FIFA Women's World Cup. An analyst asked if live is a one-off growth story or a durable engagement driver. Sarandos said it is both. Live events bring in new subscribers, reduce churn on existing ones, and command premium ad rates. He called live, quote, the highest value inventory we have. That line will show up in every research note tomorrow. The other headline from the letter and the call. Reed Hastings is stepping down from the board later this year after 29 years. He is leaving to focus on philanthropy and personal projects. Sarandos and Peters both publicly thanked him. An analyst asked if this signals any change in strategy. The answer was no. Hastings has been more symbolic than operational for years, but the optics still matter. This is the founder's final exit, and the board will be run by independent directors going forward. 3 analyst questions stood out. First, on the Q2 margin dip, Spence Newman clarified it is timing, not structural. The full-year 31.5% target holds. Second, on pricing, an analyst asked if there is more room to raise in 2026. Greg Peters said Netflix will not commit, but pointed to engagement growth as the justification for any future hikes. Third, on capital allocation with the $2.8 billion Warner Bros. Windfall, the answer was content and live rights first, then buybacks. No M&A is being pursued right now. That was a direct message to anyone hoping for another big acquisition. So, where does that leave us? Q1 was genuinely strong, but the Warner Bros. Cash inflated the EPS picture. Q2 guidance is soft on margin. Full year is in line on revenue, slightly light on margin, but stronger on free cash flow. The ad business is real and scaling to $3 billion. The live event strategy is the growth story for 2027 and beyond. The stock dropped 9% after hours on the Q2 miss, which for long-term investors might be the best kind of setup. A good company with temporarily shaken sentiment. But this is a high expectation stock. Any miss gets punished. This is not financial advice. Always do your own research. That is today's deep dive on Netflix. If this was useful, hit like and subscribe for daily market analysis. Drop a comment with whether you are buying this dip or waiting. This is the Money Mind. We will see you tomorrow.